All right, our first item that I wanted to touch on here in the part 2 of our module 6 is I forgot to bring up the Indiana county taxes and how to find what your county or any county that I have listed in the problems or the quizzes that we do, the homework assignments. You want to pull up the 2021 state and county taxes that I have there in the learning activities. And then you come down here to page 3. And remember, it's based on where you live. So if you live in Indianapolis, you're going to look at Marion County. Marion County is at 2.02%. So they're that's probably right around the average, maybe slightly above. Compared to say Hamilton County is really quite low, is only 1.1%, just north of Indianapolis. You go up to Muncie, Delaware County, 1.5%. So you can see most of them are in the mid to upper ones or the low 2%. There are some that are quite low, and then there are some that are quite high. There's some up in the 3s. I'm not going to take the time to look through all of them, but you can find, I think there was one that was in the 3s. And hopefully you're not in one of those counties, because that would be one of the highest percentages. But make sure you use this. This is the actual one there. If you look online and you would just type in Indiana county rates, it'll bring you up one that's not official and it's not by the Indiana Department of Revenue. Make sure if you do look it up that you get that one, or just use the one that I have posted for you. All right, the fair tax. So this is an actual item. This is from the U.S. Congress, and you can click on this link here. That's what this will bring you to, and it has you can keep reading about it. This is just a summary. You can look into a lot more information about it, but that's what we're going to do in our class today is, well, what is the fair tax and what's it mean? Okay, so the fair tax would basically say payroll tax and a lot of other taxes are going to go away. And the only item that's going to replace it is what's basically a national sales tax. And so the whole general rule of thumb is, there are some people that don't like the government knowing what they make. And so that would be one thing. You could make whatever you wanted to make. Nobody's going to know. You're not going to be taxed on it. You're only going to pay tax like we currently do at the state level. Well, one of the taxes at the state level. Almost all states, there are a couple exceptions, but almost all states have a sales tax. Indiana is no exception. Whenever we go buy something, we pay a minimum of 7% tax for the state of Indiana. And most of us don't even think twice about it. We just know and expect it. There's nobody out there, and it's never caught on in the news. It's never came up and said, hey, the state tax is more detrimental to the poor than it is to the rich, which it actually is more detrimental to the lower income. Because think about it, if you only had $10 and you had to go buy something, that 7 cents on the dollar that you have to pay in tax is going to hurt you more than if you had $1,000 and you had to pay 7 cents on the dollar. It's not going to hurt you as much. So a flat tax, they call this one a fair tax, and I'll tell you why the difference, but a flat tax like a state tax does hurt the lower income usually more than the higher income. Now, one of the good things though about the fair tax, you only pay based on what you spend. So if you're making money, but you're not spending it, or you're spending it only on certain items, you're not going to be taxed on it. So you get to keep more of your money. And then therefore, the one way that it's been proposed is the rich will pay more, because the rich buy a lot more big items, big ticket items. And then therefore they're going to pay a lot more tax than those who just buy little items just to make way throughout their every day. Okay, so it's going to be very similar to a state tax. The only difference then, there are a couple differences here. The one reason they call it a fair tax is because to help the poor and those that get hurt more, that get hurt more, it would be nice if they got some money back. And that's what it's going to be called a probate. And that brings us over here to this page. The 2020 schedule, what they would, if it went into effect, if the fair tax went into effect in 2020, this is what would have been paid out. Doesn't matter what you make, everybody gets the same amount. The only difference is how many people live and do you claim as a dependent at your household. So if you have one dependent, say a couple with one kid, you would get a check in the mail or direct deposited for $575 every month. And that's going to help you offset some of those, the sales tax. Because if you only buy, say, the bare minimum of goods, then you may not pay much more than $575 in sales taxes throughout the month. And therefore, this is going to just pay you back, and it's like not paying anything. But for those that spend a lot of money, maybe the more wealthy, this $575 will pay them back for those initial goods that they buy, just like anybody else. But then the taxes that they spend on the big ticket items, those are what's going to fund the government. So you would be getting a monthly check again, depending on only the size of your family, not the size of your bank account or your income. All right, so here's some of the facts about the fair tax. A, it would be pretty steep. The national sales tax, and this doesn't include any state taxes that are already there, like 7% for Indiana. This would be a national sales tax of 30%, and it would be on new goods that you buy and services. So that would be the new thing. You would be taxed on like doctor visits, or if your accountant does something for you, or a lawyer, that's a service, or you get your car repaired. Now I said doctor, that may be a medical one that they could potentially take away. The final set rules are not definitely out there. It would have to go to some committee. These are just some of the basics that are laid out that gets conversation started. So new goods and services, but not used. Okay, so not used items. So what that's going to do is in the first couple of years, the used market is going to be swamped. I mean, there's the market, everybody's going to want used goods to avoid paying an extra 30% tax. And so therefore it could hurt the economy because there won't be anybody wanting new goods. And then all those people who make new goods are going to be laid off. Well, eventually those used goods are not going to be available, or they're just going to wear out and people are going to have to eventually buy new goods. But for that first couple of years, 2 or 3 years, it could be some pretty lean times. But once we got past that curve, then it would go back to normal. But whenever there's a change, it's going to have some ripple effects, and this would be one of them. That's just, in my vision, that's what would happen. All right, so if you compare it to this 30% sales tax, you might hear people talking about it's a 23% tax really. Well, okay, it is. It can be compared to that. And when you actually go to the register, you're paying 30%. But if you compare it to our normal payroll tax, it's really only 23%. You think, how can that be? How can you have 30% and say it's the same as 23%? Confusing? Yes, definitely. Well, I think I can explain it here in this example. Basically, whenever you have a higher amount, you can tax it at a lower percentage and get the same amount. So your higher amount would be your whole paycheck. The lower amount would be the actual item you're buying. And so let's look at this little explanation and I'll explain how 23 and 30 can actually be the same amount. You go to the store and buy a $77 jacket, no sales tax. There is this fair tax now, an income tax of 23% or a sales tax of 30%. And you're going to see that it actually comes out to be the same. Option one, we have the national income tax, just like what we normally have. And you pay 23%. The 23%, now one of the items about the facts up here that I didn't really mention, and I'll get to down below, is this fair tax. It gets rid of your federal income tax and Social Security and Medicare. Now they'll still be there. You just won't pay tax on it because that 30% would cover that. So the federal, you're getting rid of your federal income tax, which would be like 10%. And then your other two, which is 7.65. So that's 17%. And then say this person made just a little bit more. They're at the 23%. Okay, so you're at a normal tax rate of 23%. You earned $100. Take out 23% in total for all of your taxes. And that includes federal and FICA. So basically you're going to bring home $77. If you take 100, take on your calculator, 100 times 23, or take out, you're basically taking out $23. So 100 minus 23, you have in your pocket $77. You can go to the store then and buy that $77 jacket and have no money left over. Again, assuming no state sales tax. Sales tax. Option 2, how we can still come away with a jacket and no money in our pocket when we're all done, is option 2 with the national sales tax. So you have take-home pay of $100, 0% income tax. So the company actually pays you $100. The state's sales tax, though, is 30%. You go to the store, pick up the jacket for $77, and they tack on 30% extra. That's $23. So if you add in the 23 plus the 77, you're right back at the $100. So a $77 jacket, you ring it up at the register, they tack on 23, they're going to charge you $100. So all of your money's gone again, just like with option 1. Option 1 and option 2, you come out the exact same. A 30% sales tax is the same as a 23% payroll tax. It's kind of weird to think about. All right, so everybody receives this probate. We've already talked about this. And so what does the fair tax do? These are all of the taxes that would be removed. Federal, FICA, anybody that still has any gift or estate taxes, dividend or capital gain taxes. Capital gains, this is like when you sell stock perhaps and you make a gain on a sale. Those would go away. Taxes on retirement income, so money that you take out when you're older, well, no more tax on that. A big one that companies would like, and maybe they could pass along the savings to you, probably not, but maybe, is the corporate tax would be gone. And since all of these taxes are gone, April 15th is gone. Now, the only downside is when April 15th is gone, that means about half of the CPA jobs are gone too. There would still be people who need to keep their books, keep everything in order, keep their finances going and have auditing, but the tax sector would be wiped out. It would be gone. There wouldn't be any need for it. Notice here with the fair tax, everyone, one of the good arguments is everyone would pay their fair share, because right now, only about 50% of people pay into federal income tax. So 1 out of every 2 people do not pay anything in taxes because they get all of their money back on the 1040, or they just don't pay anything in regardless. So when you think, hey, well, I'm having money taken on my paycheck and this guy over here isn't, and they're just living off the government, and that could make some people angry. And so they would say, hey, why don't everybody just pay their fair share? Okay. We're going to see how that works. All right, the bad side of having a fair tax, because whenever there's a good side, there's probably a bad side. It does discourage spending because you're only taxed on when you go out and spend money. So you're like, oh, do I really want to spend this money? Could hurt the economy. Now, eventually you're going to spend the money because you're going to need the goods. Bad is a 30% tax on all new goods and services. Now, the unknown, does this fair tax end up actually hurting the lower middle class citizens? The whole purpose of the prebate is that would hopefully eliminate that. But let's do some real life scenarios and let's see. We're actually going to I'm going to give you some scenarios. And then off to the side, I'm going to prepare the taxes and already have them done. And I'll tell you what this individual would have paid in 1040 tax compared to what they would have had on a fair tax situation. And we're going to see how people come across. Are they better off? Not quite so well off? Let's take a look. Real example number one. So we have a typical family here. Maybe one or both parents went to college and have a decent income. Two parents living at home, two kids, under 16. Total wages between the two adults, $70,000. So each of them makes, maybe if they make the same, $35,000 a piece. So could be a very typical household. This is what I estimated for that family of four household that they would pay that would actually be taxable expenses. And we're going to use these same criteria for all four examples that I have. All right, so some of our biggies here, food. I estimated in grocery bills plus eat out bills that they spend $250 a week. At 52 weeks, that would be $13,000. That would be paid and be taxable. Now, some food items may be exempt like they currently are for state purposes, but I'm assuming nothing right now. I'm assuming everything's taxed. Utilities, those are services, they would all be taxed. And I went through and added each of these up, and on an average basis, perhaps it would be $450 a month. And then how much that would be total that you would be spending. Okay. Your car payments, to rent it, to lease a car, your monthly payments to pay it off, repairs, gas. I estimated it to be this much, $400 a month. Miscellaneous entertainment, you go to the movies, you go to a baseball game, whatever it is, $150 a month. Miscellaneous purchases, you go to your Rickers, your Get-Go, your gas station, buying miscellaneous items, so $100 a week. And then all the other items that you could possibly have, including childcare with at least one of the kids. When you add up everything here, I have that this family spends $38,400 in taxable goods. So therefore, when they go to the register or get a bill in the mail, total, they're going to pay in tax $11,500. Now that $38,000, that doesn't include these non-taxable items that you're still going to have to pay on. So when you pay for your rent or you pay on your mortgage, that would not be taxable. And I'm going to assume an average of $800 a month. Some people are higher, some are lower, just an average. Repaying your student loans, not taxed. You're just repaying a debt. And then miscellaneous used items that you buy throughout the year. So I have it that you spend an extra $18,000, but none of those payments would be taxable. So when you add up how much you actually spend on the goods, plus the tax, plus the used goods or the non-taxable items, add them all up, and it's real close to the $70,000. So you pretty much, and that's where most people are. They spend about what they make. They save maybe some. And so this person saves $2,000 a year. Now, the fair tax calculation says, okay, you paid this, but we come over here, we have a couple with two dependents. And this one I can actually update, and I will right now. This is going to go up to, you can see this was 2019. Now this one says 2020. It goes up slightly, up to 930, 7930 for the year. And if we take 11,520 in tax that we paid, but we get a refund of 7930 back throughout the year, we really only paid, when you net all of it together, because there's no Social Security tax, there's none of that. We paid $35.90 in taxes. So that 11,000 looks bad, but after the rebates, it's not so bad. Update this, $35.90. $70,000 minus the $35.90, $66,410. what they net pay after taxes. Now with the current income tax, now maybe I shouldn't have maybe I should have left this. I think I will. I'm gonna, because the taxes that I'm doing that I've already prepared are based on, and so I want to base it on the same numbers. So even though this is a little bit different, it's pretty close. I've already done these on the 2019 tax software, and the numbers would be pretty close again, but I want to compare apples to apples here. So 2019 to 2019. If you go in and figure up the tax that would be taken out on a couple making 70 grand with 2 kids under the age of 16, it would be $1,179 that was finally due after all said and done on refunds on the 1040, plus their Social Security, plus their Medicare. This is how much tax they would have paid under our current system in total. This is the total tax they would have paid under the fair tax. So as you can see, with a family of 4, middle income, the fair tax is a better deal. Basically, it's meaning the tax is being spread out among everybody. And this middle-class citizens here, this family isn't having to pay to help those other people who aren't paying anything. So it's a really good deal for this scenario. All right, let's look at my next example. All right, what if we don't have a couple? We have a single individual, no kids, just you're 25 years old, live on your own. Well, let's see how this fair tax would affect you. Okay. So this individual makes 40 grand, has a nice job. And I did pretty much the same things as up here, just curtailed it to 1 person instead of 4. And when you add up all of the stuff that I have here, taxable expenses, after this person pays 21,000 plus the 6,396 in tax, because 30%. And then our non-taxable items, 12,600. That individual is probably not going to need as big of an apartment or as big of a house, so they're going to have a little bit lower rent. When you add up taxable spending, plus the taxes, plus the non-tax, they are just over what they made. So I got it pretty close. But it's okay that we went over because this doesn't include the prebate yet. So we're actually getting money back, remember. So we paid at the register $63.96, less the rebate. You come over here, 1 person, it's now up to $29.35. Back when I did this in 2019, it was only about $50, $60 off. So total tax for this individual is actually pretty close to what the family of 4 was, because the family of 4 gets a break because they have the kids. So 25.23, 35.23. Now, if you would go through and fill out the entire tax return for this individual with that income, you're going to find that their final amount due after all refunds on the 1040, 32.76 plus Social Security that would be taken out of their paycheck and Medicare, they would end up paying $63.36. So again, the fair tax is a really beneficial for a middle income average Joe living on their own. Save them almost $3,000 by spreading out the tax, making it more fair. All right, so 2 out of 2, the fair tax is winning. Let's keep going. Let's see what if we have this very common situation? We have a single parent, I'll say a single mom in this situation. Very common for Ivy Tech students or any like 20-year-old student or any 20-year-old adult. That's pretty common these day and age. Single mom, 2 kids at home. The single mom doesn't make a whole lot of money. Primarily lives off because she's got to take care of the kids, and after all that, working part-time, not a great paying job. The tax, she receives tax-free, that's key, tax-free child support. So that's always a maybe, isn't it? If you're trying to get child support, I would say it's maybe a 50-50 that you're going to get it or not. But we'll say that's a fair, in this case, father pays the child support, 10 grand. And she receives some food stamps as well to help pay for the meals. All right, so when we go through and we look at this individual and all of her taxable spending, kind of having to cut out different places that the more well-off family wouldn't, she ends up paying $18,000 in taxable dollars, tax of 54, through some housing allowances and different things. Maybe her rent's not too much. $4,800 in total non-taxable expenses. So when you add everything up, she makes $28,000, or she spends $28,000. Now she's got her 14 grand plus the 10, that's 24. Plus we're going to assume at least 4,000 in food stamps. Okay, so when you actually look at how much tax did this individual pay, she didn't pay 5,400. No, she paid 5,400 minus the rebates that she kept getting. So she had size of family, one person and 2 dependents. So it's up to 4,996 now. When I did it, it was 4,906. So very, very close. So a total here of only $494 in total tax. Still paying a little bit, paying her fair share. Okay. Current income tax. How would this individual have been affected with the normal situation? Well, when she files her 1040 at the end of the year, she's not going to pay anything in federal income tax, and she's actually going to get a huge refund. A, she didn't have to pay any money in, and if she did, she gets it all back from her federal withholdings. And B, because of the child tax credit refund and the earned income credit refunds, she actually gets a refund of $7,110. Now, of course, she, like everybody else, has to pay Social Security and Medicare tax, so that takes away a little bit of that. But overall, total tax that she paid was actually money back of $6,039. Whereas in the fair tax, she had to pay $494. Current tax situation, she gets back $6,000 because of all of those refunds at the end of the year. This one, she ends up paying a little bit every month. Again, it's the fair share concept. Is it fair? That's up to people to discuss. That's up to politicians to debate. But in this case, the regular income tax method was better. Again, it's going to have to be at somebody's going to have to lose out a little bit for these other individuals to save money. For these guys to say, hey, yeah, everybody's paying their fair share, so therefore I don't have to cover everybody with my taxes or cover more than just me. Somebody's going to take a hit. And in this case, it was this individual with 2 kids, a single parent. So it was not better in that situation. So as you can see here, this is the kind of the recap of what I just said. Basically, the fair tax spreads the cost of the government among everybody instead of only 50% of the people paying into, because this single parent didn't pay anything and actually got money back. So it's like a negative tax. So some people will have to begin to pay, even though it's not that much. It's only $494. But compared to getting all of this, it may seem it. All right, our last option. What about your parents or grandparents that are retired? How are they going to fare with this tax? You remember, they're not going to be taxed anymore on their retirement withholdings coming in. So that's going to save them some money. All right, so we've got a retired widow, just a single individual. She receives $18,000 Social Security, and from her 401k withdrawals of $15,000. So a total of $33,000. This individual spends maybe all of this, so $18,520 tax bill throughout the year of $5,500 in sales tax, and then her non-taxable expenses. So when you add up her expenses plus her tax plus her non-taxable, it's real close to the $33,000, $31,200. So if you take her tax bill minus the rebate, again, it's real close to this $29,35. This individual pays her fair share of tax of $26,83. Compared to the new fair tax, if you would do her tax on a tax return for 2019, and all she had was the Social Security and that retirement income coming in, she's not going to pay any Social Security or Medicare, didn't have any earned income. All she's going to have is this $303 tax on her retirement income. So she's only going to be paying $303 this year in tax with the current system, compared to the new system, $2,683. So paying their fair share, they're having to bear a little bit more of the bill. So in this one, number 4, the current income tax system is better. So now it's up to you to decide what do you think? Should it be a fair tax? Is that where maybe the government should start heading? Is it better how we have it now? Don't think of it just from your point of view, just think of it from an overall standpoint. Is it actually better? Because maybe your situation will change. Maybe you'll become a single parent, or the other way around. You'll get out of a single parent, get your college degree, get married, and start having a lot more income. That's something, and I'm kind of throwing it around to see if I somehow get this into a discussion board, because I think it'd be very interesting to see all the replies. I thought this was very interesting, something that could happen in the far future, but probably not something that's going to happen in the near future, but something just to know that's out there. All right, I'll see everybody next week. Will be our last week of actual new material, module 7, with the unemployment taxes.